In this module, we are going to discuss a number of audit tips. And it's rather a long module, so it'll be divided into parts, which you can see in a second. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. So the topics that we're going to discuss in these modules are efficiency and effectiveness, planning, dead transactions, the risk model, and we'll do some math and see why the key message of the risk model is doing less work. Go through a list of procedures that we should perhaps reconsider doing because perhaps there's no point to them. Talk about documentation. Go back to the risk model a bit and talk about the order to select procedures. Start with the easiest and the least time consuming. Talk about paving the file with documentation, which is just generally a bad idea, and we're probably not in accordance with standards if we do that. Questions to which the answer is no, and fooling the practice inspector, which we probably can't do, and if we think we are, we're probably fooling ourselves. So in terms of efficiency and effectiveness, there are two things, or maybe three or four, but I like to say that any review query is due to a lack of planning or supervision or training. And the fourth thing might be firm policies and procedures that need to be modernized. So if you're a reviewer and you're writing a query and trying to demonstrate how good a reviewer you are by writing a very large number of queries, every time you write a query, you should say, well, I obviously planned the audit badly, or I obviously supervised the audit badly, or I didn't properly train my staff in how to do this audit. And that might cause you to pause and not write a query, because writing queries is kind of a waste of time, and having staff clear queries is an even bigger waste of time. So any review query is due to a lack of planning or supervision or training. Remember that. Now, planning. Partner involvement in planning is critical. Now, it's required by standards, but even if it wasn't required by standards, I would say that partner involvement in planning is absolutely critical. If the engagement partner does not involve themselves in planning, you will have a badly done audit. It will be inefficient, ineffective, and it may risk a material misstatement being missed. The partner is to help identify risk factors with an assertion link. I think there is a risk that accounts receivable are misstated for the following reason. This affects the assertion of valuation or completeness, whatever the assertion is. If there is no risk factor identified, you will conclude that risk of material misstatement is either low or negligible. And that's one of the great things about the risk model. If risk of material misstatement is either low or negligible, the risk model is pretty clear. We don't have to do a lot of work. So that's the advantage of the risk model. Now, the other thing that's required, and again it's required by standards, but even if it wasn't required by standards, I would say it's critical, partner direction on how to respond. So if you identify a risk factor, I've identified the following risk factor with respect to accounts receivable that affects the assertion of whatever the assertion is. This is how I want it responded to. This is the kind of test I want to do to find and follow up on that risk factor. That's very important that the partner provides that level of direction. Now, if we have assessed risk of material misstatement as either moderate or high, not low, we've got to do something about it, and we've got to do procedures, guidance of the partner on what procedures. Otherwise, if it's low or negligible, hopefully, and we'll talk more about this later, hopefully a combination of one walkthrough, an analytical procedure or two, and maybe a brief substantive procedure might be enough. That's the key message of the risk model, that if risk of material misstatement is low, we don't have to do a lot of work. And even in a textbook where there's lots and lots and lots of different procedures that we could pick, we don't do all those procedures. We do enough procedures to respond to the identified risk of material misstatement. Now, the other thing to remember is analytical procedures are very powerful procedures, and they're powerful in understanding and in performance. And Hylas and Ashton did a study in 1982, and don't say, oh, that's a long time ago, it isn't relevant anymore. It's been updated since. But their finding was, and their question was, do analytical procedures identify where there is a risk of material misstatement? And they found that analytical procedures were extraordinarily effective at identifying risk of material misstatement. So if we haven't identified risk of material misstatement, we don't have a lot of work to do. And if we have identified risk of material misstatement in performance, maybe the analytical procedure can help us do that. So they are powerful and quick tests, and we need to focus on using them. Now, understanding of the client is essential for determining risk of material misstatement. You cannot do it unless you understand the company. And that is true in an audit, a review, and a compilation. And each of the three sets of standards say that. They have different levels of understanding needed, but each says you can't do the assignment without an understanding. Dead transactions. This is a concept that one of the big firms had. And basically it says, look, if you have an expense that occurred in January, the first month of the year, or you have a revenue transaction that occurred in January, in the first month of the year, or there's a journal entry that occurred in the first month of the year, it's a dead transaction. It's over. The odds of that transaction being changed, it's more than a year old when the audit's being done. It's got a much lower risk of material misstatement. Now, there's something of a difference between the balance sheet and the income statement, because the income statement is made up almost entirely of dead transactions, some 12 months old, some just a month old if it's January. The balance sheet, on the other hand, and the income statement to the extent that the transactions are together. So a sales transaction that occurred December 31st on year end, it's on the balance sheet as a receivable and it's on the income statement as a sale. So the balance sheet, receivables, payables, cash, they tend to be live transactions. Something needs to happen to confirm that that transaction really happened. Cash needs to be paid, cash needs to be received, something needs to happen. So as we're doing an audit, think about whether the transaction is dead or not. So if we're planning on examining a transaction from January, a year ago, it's a dead transaction. There's not much chance that it's wrong. If we're looking at a sale that occurred on the last day of December, that's a much more interesting transaction. We will probably approach that from a balance sheet point of view. We will approach it from, is that receivable collected? Has it been subsequently paid? That kind of thing. So dead transactions and live transactions, useful to think about separately. Now the risk model, and let's do some math. A lot of this is no longer in standards, but it used to be. The risk model is audit risk is equal to risk of material misstatement, or inherent risk, times the value of the first procedure we do, times the second, times the third, times the fourth, times the fifth. And it doesn't matter if the procedure we're doing is a control test or a substantive test. Each kind of test reduces the risk of detecting a material misstatement by some amount. Maybe not a lot, but some. Now, for control, there are 4 types of procedures that we can do to obtain evidence of control. inquiry, observation, inspection, and reperformance, doing 1. And let's assume for a minute that each of these procedures is a really bad procedure, and it only has a 20% chance of catching an error. There's an 80% chance after we do the procedure that the item is wrong. But this multiplies, so if each is at 80% chance of being wrong, 0.8 times 0.8 times 0.8 times 0.8 is 41%. So we have reduced risk of material misstatement an awful lot by doing 4 procedures together. Now, one of the things that sometimes happens in tests of control, people say, well, the only way I'm going to get evidence of control is reperformance, a walkthrough. If you do that, you're throwing away an awful lot of evidence, and then you're stuck with, like, how many do I have to reperform? And the answer might be 1,000 if you want to do this statistically. But if you value inquiry, observation, inspection, and reperformance and document it and decide it's really not very good, but you've still come a long way in reducing risk of material misstatement. So then we say, okay, I'm now going to do 2 not particularly good analytical procedures. They're broad brush procedures, but each has a 50% chance of catching an error. And I assume that risk of material misstatement is low. I haven't identified any risk factors. So 0.4 times 0.41 from the previous slide times 0.5 times 0.5 is 0.4, 4%. Now, audit risk is generally considered to be 5% or below. That's reasonable assurance. So we're done this component. We have done enough testing. And for transactions, sales transactions, for instance, expense transactions, we might just be done. For balance sheets transactions, we might say, I think I'd like to do just a little more substantive testing. Even if risk of material misstatement is low, I'd like to do some brief substantive testing just to give me a little more comfort. And that's us modifying the risk model a bit and modifying these percentages we have a bit. But this is the key message of the risk model. If risk of material misstatement is low, we really don't need to do a lot of testing. We certainly don't do every test that's in an audit textbook. So don't ignore the evidence you get from inquiry, observation, and inspection. They're very simple to get. And as I said before, some only get evidence of control from a walkthrough. You're by definition being inefficient. That's a lot of work and a lot of time. The satisfaction from doing 1 walkthrough is probably the same as doing 60. So deciding that you're going to do 2 or 3 or 5, you're just adding time without adding a significant amount of satisfaction. Now, if all you're going to do is a walkthrough, maybe you have to do 20, but then you've thrown away all the evidence you got from inquiry, observation, and inspection. But you produce impressive documentation. You've got all this, and I remember being a manager and reviewing. We do 60 walkthroughs. It was magnificent documentation, though there's some academic research that suggests that even though it looks pretty, probably people have missed stuff unintentionally, and so it probably doesn't give us the satisfaction that we thought it did, though the audit wasn't wrong, so I don't know what we were doing. Perhaps this was a bad way to approach auditing. So the other thing that we have to remember is risk of material misstatement means we are looking for a journal entry. So whatever test we're doing, we have to have as the end result, debit this, credit that. Now, presumably in an audit, we are looking for things that increase expenses and increase liabilities or reduce assets. The other way around, looking for revenue that the client has forgotten to record or deciding they're depreciating their buildings too fast or something like that, probably much less likely. So we've got to always be focused on what journal entry am I going to find or provide? And again, procedures are only done directed at risk of material misstatement. The exception, of course, is understanding. We have to do risk assessment procedures, which don't necessarily give us evidence. They could be modified to do so, but we have to do those to obtain an understanding of our client, which can be updated from prior or whatever. So a procedural audit, if all we're going to do is do oceans of procedures, it will be time-consuming. We'll have very pretty working papers. We'll have lots and lots of documentation of lots and lots of work done. But the most significant problem, other than took a long time and is boring, is we haven't thought about risk of material misstatement, and we may miss a significant risk of material misstatement, not do any work on it, and give a clean opinion on an audit where the financial statements contains material errors. And that's a big problem. So we've wasted a lot of time, spent a lot of time, not focused on the things we should have focused on, and in the end we have an audit that's faulty and there's an error that we missed. Now, the other thing about a procedural audit is if you did it procedurally last year with no reference to risk of material misstatement, this year someone will come along and say, well, that's a wonderful list of procedures, but we haven't done this procedure from the auditing textbook, so shouldn't we do that? Sure, why not? You have no argument for why the procedure shouldn't be done. It's a nice procedure in the auditing textbook. And then you'll wonder why every year we're going more and more and more over budget. But again, we'll look at the file and go, man, there's just pages and pages of pretty documentation. But the point of an audit is not producing pretty documentation. The point of an audit is addressing risk of material misstatement. Now, control testing, we have design and implementation and operating effectiveness. Standards, when they talk about these in the standards, they separate it and say, okay, here's what we do on D&I, and here's what we do on operating effectiveness. In real life, it's probably not that practical to separate the two. In real life, the testing we do, a walkthrough, for instance, does both D&I and operating effectiveness. So, to do it separately is probably more work than to do it together. And together is simpler. Now, sometimes all we care about is D&I, and so we'll do whatever we need to do for D&I. And if we find a little bit about operating effectiveness that we don't need, oh well, that's fine. We'll just proceed. Now, a walkthrough. Following a few transactions through the financial reporting system. That's what the glossary says. And notice it says through the financial reporting system. A lot of the times we walk through the accounting system. We don't care. They're all parts of the accounting system that do not have any relation at all to what appears in the financial statements. So we don't care about that. When we're doing a systems walkthrough, we want to walk through the financial reporting system. How does a transaction enter the company and end up as revenue in the financial statements? The other thing 315, the appendix says, is a walkthrough is a way of getting an understanding. So it could be part of our risk assessment procedure as well. Now, when we are evaluating a walkthrough or any control test, it's either kind of pass or fail. It either worked or it didn't. And if it doesn't work, we kind of have to throw it all away again and start over. So various firms have invented various, if we do 20 transactions, we can have no more than 2 deviations. Often if you do 20 transactions, by definition, you get 2 deviations. So that approach tends to be not particularly valuable. But for a walkthrough, did it work? Did it work the way we expected it to? Did the financial reporting system work as we expected? And I said this before, but there's little additional comfort in a walkthrough from doing 2 or 3. So 1 per transaction stream is often enough. That's a decision you need to make. But if you've assessed the risk of material misstatement as low, perhaps not a bad decision. So this is the end of part 1 of 4. So thanks for listening, and please see part 2.